Welcome back, everyone, to the Deep Dive. Really excited today. We're diving into a truly foundational text for anyone serious about investing. Benjamin Graham's The Intelligent Investor.
That's right. Often called the Bible of value investing.
And Warren Buffett himself, probably Graham's most famous student, called it by far the best book on investing ever written. That's quite the endorsement.
It really is. And our goal here, is to pull out that core timeless wisdom for you. The language can feel a bit dated sometimes, maybe a little dense.
For sure.
But the principles underneath, they're gold. We want to help you cut through that and get straight to the ideas that can help you build wealth today.
Okay, so let's get into it. To really understand Graham's approach, you first have to grasp this key distinction he makes. It's about the investor versus the speculator.
Crucial difference.
He basically says an investor operates on research, on discipline, and this concept he calls a margin of safety. Whereas a speculator, they're more about predicting market moves, maybe chasing hot tips,
Right.
often driven by emotion, right?
Yeah, exactly. Graham was very clear. Investing is about analyzing the underlying business, its value. Speculation is betting on price movements. And that margin of safety you mentioned, that's the cornerstone.
Explain that a bit more. What is the margin of safety, practically?
It's really about buying a security for significantly less than what your analysis tells you its intrinsic value is. Think of it like buying $1 for 50 cents, maybe 60 cents.
Okay.
That gap, that difference, that's your buffer. It protects you if your analysis is a bit off or if things just go unexpectedly wrong. It's fundamentally about minimizing downside risk. Capital preservation first.
Which leads perfectly into maybe his most famous idea, Mr. Market. This analogy is just brilliant.
Oh, it's fantastic, and maybe more relevant than ever with today's 2047 news cycle and market swings.
So describe Mr. Market for us.
Well, Graham asks you to imagine you have a business partner, Mr. Market, and this partner is, let's say, emotionally volatile.
Sounds familiar.
Right. Every single day he comes to you and offers to either buy your share of the business or sell you his. But his prices are all over the place, driven by his mood. Some days he's wildly optimistic and quotes a crazy high price. Other days he's panicked, deeply pessimistic, and offers to sell his share for way less than it's worth.
So the intelligent investor doesn't get swayed by these moods.
Precisely. You don't have to trade with him. You can ignore him completely on days his prices make no sense. But, crucially, you should be ready to take advantage of him when his quotes are ridiculous, either buying low when he's depressed or maybe selling high when he's euphoric. It's about using his irrationality to your advantage, not getting caught up in it.
It really reframes how you should view market fluctuations. Okay, so knowing about Mr. Market, how does Graham suggest we should operate? He talks about different types of investors.
Yeah, he makes another useful distinction. The defensive investor versus the enterprising investor.
Defensive and enterprising. What's the difference there?
The defensive investor is basically looking for safety and freedom from effort. They want solid, stable returns without doing exhaustive research. Think blue chip stocks paying good dividends, or maybe index funds, kind of a set it and forget it approach, almost.
Okay, lower maintenance.
Exactly. The enterprising investor, on the other hand, is willing to put in the work. They'll actively research, dig for undervalued stocks, maybe look into special situations. It requires more skill, more effort, but the potential rewards could be higher. It helps you decide, how much time and energy you personally want to commit.
That makes sense. And beyond these frameworks, a huge theme is just discipline.
Right.
And managing your own psychology.
Oh, absolutely central. Graham hammered this home. He believed, and I think experience bears this out, that your success depends far more on your temperament, your emotional control, than on, say, IQ points or complex analysis.
It's about not panicking in downturns or getting greedy in bubbles.
Yes, exactly. Controlling your own impulses. Your biggest enemy often isn't the market, it's you. Can you stick to your plan? Can you remain rational when everyone else is losing their head? That's the real challenge Graham focuses on.
So if someone's thinking about picking up this book today, what are the main pros and maybe cons they should be aware of?
Okay, pros. The principles are genuinely timeless. It's fantastic for building a solid foundation for long-term wealth and financial independence. It really teaches you a rational, risk-averse framework. The cons, well, the original text can be dense. It's definitely not a get-rich-quick guide or full of hot stock tips.
Right.
And it requires patience. Graham's approach is about the long game. Years, decades, not days or weeks.
That leads to a good practical tip we found. For newer readers, maybe grab an edition that includes commentary by Jason Zweig.
Oh, definitely. Zweig's commentary is excellent. He updates Graham's examples, explains concepts in modern terms, makes it much more accessible, I think. It bridges the gap from Graham's time to ours.
Good advice. So who is this really for then?
Honestly, I'd say it's a must-read for any serious investor. We rated it 9.5 out of 10 for a reason. Beginners who want that solid bedrock. Intermediate folks trying to avoid market hype and fads. Really, anyone focused on building wealth steadily and safely over the long term.
Yeah, it might not be a thrilling page-turner like a novel, but the wisdom inside.
Yeah?
It's just priceless for building wealth with patience, discipline, and logic. It really holds up.
It absolutely does. And maybe that leaves you, the listener, with something to think about. Given these timeless ideas, how are you letting Mr. Market's current moods, whatever they may be today, influence your own long-term decisions? And thinking about those categories. What kind of investor do you really aspire to be? Defensive, enterprising, or maybe something in between?